Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's derivatives expert and founder of Kirby Analytics. Rob Kirby, thank you for joining me again.
Pleasure to be with you, Jason.
Yeah, Rob, I always enjoy our discussions. We don't hear a lot on the mainstream financial media talking about interest rate swaps and currency swaps and things like that. I think, they intentionally leave this out. So my first question for you then is all the mainstream financial media types, it seems like every couple months, they double down again and they keep saying, oh, the Fed now on data-dependent Fed, the Fed's going to finally, test the waters and increase interest rates. What's your opinion on this supposedly almost guaranteed interest rate increase in December? How much ammunition does the Fed have left?
I don't believe it's a sure bet to begin with that the Fed will actually raise rates in December. And if they do, in fact, raise rates, nominal rates at all, Jason, I believe that it will be extremely nominal, and it may also be accompanied by another blizzard round of additions of interest rate swap product, which indeed would actually lower the long end of the curve. So I could see actually a flattening of the curve if the Fed were to increase the Fed funds rate by perhaps 25 basis points and move the range from 0 to 25 up to optically 25 to 50. They could then, in fact, maintain a 25 basis point Fed funds rate, but then they could lather on a new layer of OTC derivatives, swaps, and FRAs to, in fact, lower the government's borrowing costs in, let's say, 2 years right out to 10 or 30 years by flattening the sort of the belly of the curve by adding these OTC instruments, because a lot of people don't really understand. At least people in the mainstream don't seem to ever want to talk about it, because talking about it would invite a discussion, and a discussion would invite some investigation. And the investigation, if it was sincere and legit, would show that OTC interest rate swaps have been used extensively by the US Treasury in conjunction with the Federal Reserve to force medium-term interest rates down. And the reason this can happen is because embedded in every interest rate swap is a bond trade, because these instruments, interest rate swaps, that is, trade literally as a spread relative to government treasuries, on-the-run government treasuries. And with the U.S. Treasury being a receiver of fixed rates in the 3 to 10 year terms, they can make the spread-playing banks captive buyers of literally any amount of 3 to 10 year U.S. government debt which they wish to issue. And this has, in fact, happened. The footprints are left in the snow for posterity's sake by reviewing historical quarterly derivatives reports, which are produced by the Office of the Comptroller of the Currency, where aggregates of the bank's swap books are recorded in arrears every 3 months and published by the Office of the Comptroller of the Currency. That's a bit of a mouthful. If you have questions, I'm open.
That's very interesting. And in the mainstream financial media, I don't even really hear them at all talk about the debt problem anymore. When people say they're going to raise rates, we hear that, oh, the Fed has to raise rates. Rates have to normalize. I don't hear anyone who says that on Bloomberg or CNBC actually talk about, if we did raise that, we're looking at, for every 1% increase, $200 billion in extra interest payments on the U.S.'s debt. So it's just very mind-boggling. Now, the interest rate swaps you brought up, I actually saw it was either Bloomberg or Reuters. There was a story on this last week, maybe about 10 days ago, I think. I could send you it later after the recording. I actually saw that Wall Street banks are trying to offer discounted interest rate swaps. They're trying to get more people to go out there and buy them.
Well, if you look graphically at the tables that are published in the quarterly derivatives report published by the Office of the Comptroller of the Currency, you will note that because it's graphically displayed, that end user demand in terms of real end user want or need for these products is non-existent, and that the overwhelming majority, as in the high 90 percentiles of these instruments, are basically trading of basically 5 institutions. And the 5 institutions that do this trading, the select 5, preferred counterparties of the Exchange Stabilization Fund in this trade, which forces rates to the levels that they're at. Those institutions are J.P. Morgan, Citibank, Bank of America, Morgan Stanley, and Goldman Sachs. And these are the very institutions that are frequently and often mentioned to be the enforcers or the hired muscle to, let's just say, rig markets or produce engineered outcomes that are favorable to the ruling elites. Whether you want to say it's the U.S. Treasury, which I believe, or the Federal Reserve, is immaterial.
Yeah, Rob, you mentioned how the yield curve could be flattened almost all the way to zero on the short, medium, and long eventually at some point, so governments can continue to borrow more and more money at lower and lower interest payments. I think this goes back to what Keynes actually wrote about in the general theory, and people say, oh, Keynes wouldn't have wanted this, but if you read the book, and there's a great book for our listeners out there, it's called Where Keynes Went Wrong by Hunter Lewis. I just read it. It's on Audible audiobook, and he goes through the general theory, and he talks about how Keynes basically wanted to ruin capitalism, and how Keynes wanted the interest rates, during a depression, he wanted to take the savings away from the middle class and rich people. We call them the rentier. And he wanted interest rates lowered all the way to zero. He said when the economy is bad, no one should be making any interest. And as long as the economy is bad, the interest rate should go lower and lower all the way to zero. So it seems to me that that's the blueprint for what's being planned. And the developed countries are ahead of this. Japan, the U.S., Europe are ahead of this. There are massive interventions in their interest rates and bond markets and things like that. But now you see, large other countries like China starting to get into this too with, financial repression. You mentioned, though, that the banks are being, held captive, to force to buy these things. Do you think then the next logical step is some sort of bail-in where maybe there's, $16 trillion approximately of savings for U.S. citizens in their 401k and IRA plans and other retirement accounts? Do you think then in the near future that the American citizens are going to be forced for national security or whatever stupid excuse they're going to give to put, 1% or 5% of all their total assets into Treasury bonds to support the U.S. government or something? Well,
the answer to that, Jason, is pretty much as follows. The Exchange Stabilization Fund, when it conducts these trades with the banks, what I did say is it makes the banks captive buyers for fiat, for nominal fiat gain, and in doing so, if the Treasury were to ever get any of these banks wrong-footed, I'd first begin by saying it's not likely the banks are going to get wrong-footed because these big banks know what U.S. monetary policy is in advance. So they're dealing with insider information right from the get-go. And when you know what U.S. monetary policy is and is going to be, it's very hard to get wrong-footed on a very large bond position, full stop. So keep that in mind. Now, if banks happen to go out and do renegade things and get wrong-footed in other areas, the U.S. Treasury has ways that they can bail them in or bail them out via stealth means. And we saw a perfect example of this occur back in 2008 when Morgan Stanley, when the Treasury and the Fed were clearly trying to marry Morgan Stanley to anybody who would take a second look at them, and they couldn't find anyone that would consider buying Morgan Stanley. This was in the aftermath of Lehman failing and the forced marriage between B of A and Merrill Lynch. Morgan Stanley was was rumored to be on their deathbed as well, but they couldn't find a big enough sucker to take on Morgan Stanley. And so what did happen is during this period of time when the credit markets were frozen and banks wouldn't even lend to each other in the overnight markets, and credit instruments had come to a halt and there was no trading, that's when Morgan Stanley, in 1 3-month period at the height of their shakiness, they strapped on $8 trillion worth of these aforementioned credit instruments called OTC swaps. They strapped on $8 trillion worth of them in 3 months. Now, the big thing to listen to in what I just said is these OTC swaps that we've been speaking of, these are credit instruments. Well, banks weren't lending to each other on an overnight basis, and we're to believe that Morgan Stanley actually did legitimate business in the interbank market to the tune of $8 trillion in 3 months in their swap book. You know what, Jason? That is as believable that it happened in a real free market. That's like saying I have 50 elephants in my living room, and when they're going to leave tonight, they're all going to jump through the keyhole. You see, that did not happen in a free market, and that's what exposes this fraud. The fact that Morgan Stanley reported $8 trillion add in that part of their derivatives book in those credit instruments, the only counterparty possible that would A, take the credit, and B, would have the motivation to do it, is the US Treasury. And the US Treasury was the other side of those trades, and they were stealth recapitalizing Morgan Stanley using derivatives because they were giving them can't-lose layup trades that they could book profits on. And that's how Morgan Stanley got to rebuild their balance sheet. And you know what? And all I can say, any professional that understands the credit markets and can look back and see how they added $8 trillion of those instruments in a 3-month period, shame on you if you can't spot something that big.
The only mention of any of this with derivatives that I hear ever on CNBC or Bloomberg is that, everything's netted out, everything's fine, don't worry, we're not going to have another 2008. I think, the problem just keeps getting larger and larger. And when you see evidence that the Wall Street banks are trying to offer discounted interest rate swaps, they're desperate to bring in more suckers so they can take their money. But before the show, before we started recording, you talked about all markets being dystopian. I mean, it seems to me, Rob, the technicals for the general stock market a couple months ago, it was about to do a cliff dive, and then the charts get painted again. So it seems to me they're really fighting the tape to prevent the stock market from crashing. They want to keep the real estate prices high. They want to keep bond prices high and interest rates low. Every government or almost every government is massively intervening for foreign exchange rates, for the exchange rate of their currency to try to get some type of trade advantage or do a hidden currency swap. It seems to me there's more markets that are manipulated right now than are not.
Oh, absolutely. Well, I mean, listen, Jason, just a few minutes ago, you prefaced the last topic by saying, speaking about what Keynes wanted. John Maynard Keynes, what he wanted. When you start speaking about what Keynes wanted and what Keynes was getting, Keynes was a very unsavory character. And the people who worship the teachings of this man should be reminded what a disgusting piece of humanity he really was. Because this man was a pedophile to the extreme that he made Jimmy Savile look like a choir boy. This man was a piece of filth, and in my view and where I come from, his leanings and teachings and his whole Keynesian philosophy isn't built on any more or any better foundation than his moral character, which was completely and utterly from the sewer. Because anybody who starts with the preface that an appropriate monetary regime for the world is a system that's characterized with the commentary right from the man's own lips that in the long run we're all dead anyway. I'm sorry, Jason. I don't want my legacy to be that I didn't give a crap about what happens during my lifetime, because in the long run we're all dead anyway.
Well, Keynes
was, and that is completely. If you want to know in a nutshell what Keynesianism is, it's a neon sign that says in the long run we're all dead. And I'd like to think that humanity's prospects, under some prudent guidance, instead of the spendthrift crap, humanity's future might be a little brighter than we're all dead anyway.
I also think Keynes was an evil genius and a James Bond villain. He would have been perfect in one of those James Bond films. You know, he was power hungry. He had no morals. Murray Rothbard wrote a great. You know,
Jason, there's never been a pedophile in a James Bond movie. This man was a pedophile. This is what he was committed to first and foremost. This man was such a wretched piece of crap humanity that he wasn't even welcome in a lot of countries, because they knew what he was up to. And this is documented. You can Google Keynes Lavender. You can read about it. It's documented. But of course the mainstream press doesn't want to bring up any of those inconvenient truths either.
Yeah, Market Skeptics has some videos on it. Yeah, Keynes also wanted, Rob, one world government and one world currency, and he wanted all commodities manipulated with international cartels. So he was a hardcore, New World Order globalist type of person.
Absolutely.
Well, I want to talk about currency swaps. We were talking about this also before the show. You mentioned on your interview with Greg Hunter the last time you were on there, I think, a surprising currency swap. I hadn't heard it before you mentioned it on there, that Russia and China did one. I broke a story recently, too. I found a news item that I hadn't seen other people commented on, that China is now in the process of negotiating a very large bailout currency swap of Venezuela in exchange for large amounts of oil. Why are we seeing more currency swaps lately?
Well, it's I'm going to say that it's China. China assisting or coming to the aid of countries that have been screwed over by the West. I mean, understand the West has currency swaps, interlaced with each other till the cows come home. I mean, America has currency swap arrangements with the Bank of Canada, with the Bank of Switzerland, with the Bank of Japan, with the European Central Bank, and probably with another list of central banks that we can't even remember the names of. So these currency swaps give the central bankers flexibility in propping up if there should be a run on any particular of the member currencies. They can quickly mobilize resources in one of their friendly neighbors' currency to sort of shore up the deficiency that might be arising in one place. So it's basically a way of trying to make this fundamentally broken, insolvent regime of fiat money to try and make it look like it's strong by allowing one member to prop up the next member's currency. So the Chinese have really learned from the Keynesian boys centered in the Anglo-American sphere. They've learned from them that they can help their neighbors by instituting these swap lines and make their trading neighbors, as Venezuela is for China, not as easy a prey, because the central bankers in the Anglo-American sphere, they prey on the weak, and they prey on people who aren't with them. So the Chinese have realized, and the Russians have realized, they can use the same tactics to make their trading neighbors not as easy a prey for the West. And so they use it. because it's a tool that exists that was developed by the West.
Yeah, I mean, these things have exploded. Like they used to do. I've interviewed James Turk in the past, and he said that in past crises like the tequila crisis in Mexico or the Asian tiger crisis, they did smaller amounts of currency swaps to bail out American or European banks, but the size of these things, I think you said since 2007, 2008, they've just absolutely exploded. Would you characterize then what you just described with the currency swap system? Would you say then that the developed world countries like the G7 then, they're doing them with each other, like the U.S. and Japan, the U.S. and Europe,
the G20,
to preserve the status quo?
The G20 would be a better descriptive or a better way to bracket, the G20, but I mean the G20 there again probably that includes probably Russia and China as well. So, but absolutely the G7, the G7 plus were the first to. They were the pioneers of these currency swaps, and they use them. They use them liberally.
Yes.
The idea is if two aspirin can cure a headache, then a whole bottle of aspirin is surely very, very good and is gonna take you to a utopian bliss.
Well, normally a whole bottle of aspirin will get your stomach pumped if you're lucky, or it'll be an overdose. So, but I mean, it seems to me. I've said this on other podcasts. It seems to me like the people in the G7 are doing the currency swaps to prop up asset prices, protect their banks, maintain the status quo. And then you have China doing the currency swaps with Russia and Brazil and Venezuela, their other trading partners, to set up the next financial system. Is that what you see, or do you see things differently then?
I'm going to say that that may be the case, but what they're doing is they're giving when China's doing currency swaps with trading partners of theirs, they are giving their trading partners, I'm going to say, a liquidity backstop, which allows their trading partners to continue operating in a world where they've been probably singled out for failure, and it allows them to continue, being engaged in commerce and trading their resource wealth. Like, don't kid yourself, China's getting something out of this as well. They're getting access and guarantees to resources to continue operating, their economy on a growth trajectory, into the future. So I mean, it's sort of a mutual two-way benefit thing, but absolutely it occurs, and who knows? I mean, the globalists that run our world, even though you laughed about it, I really do believe that they believe that if two aspirin is good for you, then many more will certainly be better. So I expect we will continue to see more and more of this going forward.
Yeah, the emerging markets, Rob, when commodity prices were higher, they took out a lot of U.S. dollar denominated debt. They leveraged their economy to China, and now commodity prices have fallen. A lot of the mining companies and oil companies and agricultural companies, they've experienced a big commodity bear market. Some commodities have done a lot worse in the last couple of years than others, but, the debt is still there from when commodity prices were higher and cash flow was higher. So it'll be interesting to see if China is kind of helping these guys maybe do a strategic default, maybe on their U.S. dollar denominated debt, and giving U.S. banks and the Western system the middle finger while they transition to, working with China more, working with Chinese banks and the new financial system.
Well, listen, you certainly can't ignore the fact that China is erecting parallel structures to the institutions which have ensured and been maintaining dollar hegemony, namely the World Bank and the IMF. China and the BRICS countries have been building parallel structures to both the IMF and the World Bank, with their BRICS Bank and their redevelopment bank that is similar in function to what the IMF does. So. Yes, I would say they absolutely are building parallel structures to the traditional dollar-centric structures, and they continue to build more robust relationships with their members, because like you take Venezuela for instance, they're basically part of the BRICS complex, and or they're aligned with the BRICS complex. So yep, I expect we continue to see more of that as time goes along.
Now, there's been some very interesting comments recently by Christine Lagarde of the IMF, and it seems that a lot of the non-U.S. people at the IMF are very much interested in allowing the Chinese RMB into the SDR basket, but the U.S. government is attempting at least to delay things for a while, although I think this is basically inevitable. Do you think the U.S. is going to be successful then at blocking China getting the RMB into the SDR basket for that much longer?
I think that a lot of American moves and activities in the very recent past and continuing to this day have actually served to drive a wedge between many of the members in different groups, starting with like NATO. American-European relations, I think, are likely about as low as they've been in a long time right now, brought on largely by the absolute wanton destruction of so much of the Middle East, stemming directly, out of U.S. foreign policy moves, creating a crisis of migrants that are literally decapitating the economies and many of the countries in Europe. So I'm sort of answering your question as you put it to me, in that America's causing a lot of problems with their historic allies by, let's just say, by misguided, very, very misguided, and I don't believe well thought out policies. Unless your policy is to basically to destroy the world and remake the world in some globalist utopian Maoist vision, which maybe that's really what George Soros and company really have in mind, because there's a lot that's written that supports that contention.
I want to talk about deflation before we talk about precious metals and the gold and silver miners at length, which you also are an expert in. Do you think central bankers are going to allow deflation for a long period of time without further intervention?
Well, when you speak about deflation, what Western central bankers have done is they've effectively destroyed their own currencies. They've literally crapped in their own nests, and this hasn't been allowed to just like so many other fundamental things in economics haven't been allowed to manifest themselves properly through market rigging, through engineering outcomes, by only allowing financial instruments to appreciate in price, like artificially rigging the price of bonds up, artificially rigging the price of precious metals and anything that's strategic and tangible down. If you're talking about what's the natural and fundamental, or what should be the natural and fundamental outcome from all this money creation by Western central banks, the currency should be hyperinflating, or prices should be hyperinflating, but they haven't been allowed to hyperinflate yet. But the damage has fundamentally been done to the currency. And it would be much like me saying there's a shortage of air, and people saying to me, what do you mean there's no shortage of air? Everyone's breathing. But then I throw a plastic bag over your head and tie it around your neck, and you suffocate. Well, there certainly is a shortage of air for you under that circumstance. But you see, that's not natural. And in the real world, that's called murder. And many of the outcomes that we're witnessing in our capital markets are tantamount to murder. And you know what? The people at the Exchange Stabilization Fund who are engineering and creating these outcomes, I know they all rest on their laurels thinking, because by the law that created the Exchange Stabilization Fund, this secretive slush fund back in 1934, in the same piece of legislation that confiscated gold from American citizens, as the law is written in America, the Exchange Stabilization Fund is subject to no oversight by anyone, and is operated at the pure discretion of the Secretary of the Treasury, and they're not subject to any laws, and they can operate in any market they see fit and do whatever they want. I'll tell you what this reminds me a lot of. It reminds me a lot of a group of unsavory characters that gained power in Germany in the 30s. And they passed all kinds of laws that said it was okay for them to do whatever they wanted to. And then they went and did it. But there were some guys that sat behind at benches in Nuremberg, and they didn't see the world the same way. And you know what? I think these clowns that have perpetrated these high financial crimes against humanity, I think they're going to ultimately be awaiting much the same fate.
Rob, it seems like a lot of this inflation, it hasn't gone necessarily into consumer prices as much, or food companies have hidden them with lower portions and kept the price the same. But a lot of the monetary inflation has gone into asset prices. So we have record art prices, things like we have diamond prices of diamonds, going through the roof in a lot of aspects. We've had the bond market propped up, real estate market propped up.
Yep,
so it seems like that a lot of when I interview a lot of the regular Wall Street people or speak with them off the record, a lot of them won't admit that there's any asset price inflation. They repeat the Federal Reserve or Wall Street company line that, we're in full deflation now. There's been no asset price inflation. They quote statistics saying, stocks are not that much higher than normal PE ratios and things like that. And
Jason, listen, we've already discussed this. You see, I can print all the money in the world, but then I can take select strategic things that have derivatives or futures connected to them, and I can effectively put a plastic bag over their head and strangle them. But that's not real deflation. That's just called a criminal act. Don't confuse a criminal act with a natural market outcome. I mean, I can actually create a false according to nature situation where if I put a big fan underneath me, Jason, I can drop a plate and it will fall up. But that doesn't mean there's no gravity. That means that I've created an artificial false construct to make it appear like plates fall up. But let me tell you, plates don't really fall up. You take the fan away, and the plate becomes little pieces on the ground. And you see, you can effectively do, and they have done the same thing with the metals, except they've got the fan above pushing it down. And on the bonds, they've got the fan on the floor pushing the prices up. And they can move the fan around, and they can make one currency go up against the next, and another currency go down against another. And you see, this is the descriptive. This is the dystopia that our capital markets have become. And this is why institutions that have $50 trillion books don't ever seem to get caught wrong-footed, because they're dealing with engineered outcomes. And let me tell you, if you have a legitimate $50 trillion derivatives book, if you get caught wrong-footed, even marginally, like just think about it. If you have a $50 trillion derivatives book and you get wrong-footed or get caught where you're offside, like by 0.5%, a notional, like you are now in the hole more than your market capitalization. But lo and behold, if that is to occur, there's also rules in America where the intelligence czar in the United States of America is allowed to grant publicly traded companies a waiver where they don't have to report their true financial condition, which effectively means that companies that are granted a waiver basically have their accounting suspended. They don't have to do accounting. And I'll tell you something. When you have corrupt, crooked officials with the ability to grant a company, if it's in the name, of course, always, Jason, if it's in the name of national security, but some companies are subject to accounting all the time, and other institutions are only subject to accounting when the powers that be say. You see, this way you can selectively pick off your competition, and and you can just collect the spoils. And this is pretty much what this fascist oligarchy, it's the perfect example of what this fascist oligarchy really is. It's the merger of corporate and state, where people in back rooms decide who's going to be subject to accounting, who's not going to be subject to accounting, and the competition melts away. And it's how the sick and perverted consume the healthy and productive. And this has been going on for a long time. And this is going to continue to go on until people say no mas.
Rob, I want to talk about the gold and silver industry, the fundamentals of gold and silver, and also the gold and silver miners. With this manipulated paper price, now obviously the currencies of miners in like Mexico and Canada, the currencies are weaker against the dollar. That's helped the miners a little bit, but a lot of them still have dollar-denominated debt. In your opinion, how much damage is the manipulated paper prices for gold and silver doing to the mining industry?
Oh, the mining industry's been devastated. Just think of the big names who are on the ropes: Glencore, Barrick. There's been waves of consolidation in the juniors. That industry is a complete and utter nightmare. But I mean, you juxtapose those conditions against, well-reported and well-documented record demand for physical precious metal right across the board around the world, and as the price of silver and gold have been bashed down over the last 5 years, we've seen physical demand grow geometrically, and we've seen nothing but a relentless increase in the call it the leverage of the paper traders like the COMEX and the LBMA, where price discovery is supposed to happen. I mean, it was reported back in 2010 in CFTC testimony that was entered by Bill Murphy of GATA fame and Adrian Douglas of GATA fame. Testimony was given in a CFTC committee that the COMEX used to sell or used to have for every ounce of gold they had in their vaults or in their depositories, they had sold roughly 100 or just over 100 ounces in paper form. And we've seen that this ratio of physical to paper in the instance of the COMEX over the latest 5-year period, we've seen that grow from over 300 or around 300 ounces of paper is now sold for every ounce of the physical metal that's held in depository. So what it shows, what that growth from 100 to 1 to 300 to 1, what it illustrates is the dogged determination on the part of officialdom to bash the price, the nominal price of an ounce of gold down from where it was 5 years ago when it topped out at $1,900 an ounce, down to just under $1,100 nominally in U.S. dollars right now. And the reason that all occurred, Jason, is because central bankers, and specifically the U.S. Treasury, has been continued to issue debt like drunken sailors. They've created ridiculous amounts of money, and to make the money appear like it still possesses value, you've got to make its peers or its alternates look bad. And the way they've done that is to sell paper promises of metal like there's no tomorrow, to force this supposed price-discovered outcome to people that gold isn't a good investment and isn't a good alternative to their fiat money. And the reality is, and fundamentally, nothing could be further from the truth. So, and that's why other countries that aren't part of the Western central banking clique have been buying physical metal like there's no tomorrow. And the function that the Chinese and the Russians have been fulfilling in the last 5 years is exactly the same function that de Gaulle, as the leader of France, performed during the London gold pool when America was printing money to finance adventurism in Vietnam and in Eastern or Southeastern Asia. When Americans arrogantly said, our dollar's as good as gold, and de Gaulle said, then give me gold. And what that led to was President Nixon closing the gold window in 1971, in August of 71, and where we're headed for, according to the laws of economic nature, we're headed for ultimately a bust in these paper markets, because these paper markets do require a validation of their fraudulently derived price. They do have to expel some physical metal, otherwise their paper game is exposed as the lie and the fraud that it really is. So how close are we to that happening? I think we're pretty close.
Yeah, the London gold pool was an overt form of manipulation. I think they even ran ads in British newspapers saying, why people shouldn't buy physical metal and how bad it was and things like that. Now the manipulation, it's gotten a lot more sophisticated and covert, using paper derivatives and, using the mainstream financial media to put out articles like gold is a pet rock and things like that. But in terms of the fundamentals for silver market, we see demand exploding for physical silver out of India. I think it's over 10,000 metric tons that India is on a pace to acquire over the last 12 months, and this has an effective price. We've seen the copper price fall, base metals fall. The majority of annual silver production, Rob, I think is like 70%, give or take, for silver as a byproduct. If those mines come offline, and we know that the primary silver miners are also struggling, they're high grading their mine. Some of them, with the lower silver prices, may even have to shut down or go bankrupt. Where do you think the silver is going to come from then? The silver that's been coming from, is it coming from SLV? Bill Holter, I interviewed a couple weeks ago. He actually said the Chinese are supplying physical silver to the West in exchange to get more physical gold. Do you think any of these things, either silver from the SLV or Bill Holter's theory about where the silver is coming from, do you think any of those things have merit?
Well, listen, when I look at the gold-silver ratio at, what is it, roughly 75 to 1 last I checked, and I don't know where it is today, I would not be exchanging 75 ounces of silver to anyone to get 1 ounce of gold. So I don't think that thesis really holds a lot of merit, to be honest with you. My feeling is if the Chinese, I don't fundamentally think the Chinese are stupid. And to suggest that the Chinese would be willing to exchange 75 ounces of silver for 1 ounce of gold, I think would almost paint them in a role of being stupid and dupes. If China was supplying silver in exchange for physical silver in exchange for physical gold, I believe that the gold silver ratio would be narrowing or showing signs of narrowing significantly, and that's just not happening. So, and I know a lot of damage can be done in the paper markets, because you see when an ounce or a contract of silver or gold or silver is sold on the COMEX exchange, the recipient of the sale doesn't really differentiate a paper ounce from a physical ounce. And in price discovery, a paper ounce and a physical ounce look the same, or they don't feel different because they act and they behave the same. But the reality is way more paper. The guy who describes it very well, this Ponzi fraud is Turd Ferguson, Craig Hemke, and he describes it, with the leverage that COMEX currently is exercising in the gold. It's really like a game of musical chairs, where you have one chair, you've got 300 people circling one chair, and the music's still playing. And when the music stops, a whole lot of people are going to be looking for a chair, and there isn't going to be one. And that is the picture of our current precious metals complex.
Yeah, I agree. This is 100% unsustainable. We have an oil price now at $40 where, OPEC is in major trouble and shale oil producers are in major trouble. We have a gold and silver price back to almost 2009 levels now, where the miners brought on a lot of higher cost mines in the last 6 years or so, and they took on a lot of debt to do it. Almost all the miners used debt to do it. And they've been high-grading mines and things like that just to survive, taking on either more debt or selling shares.
And all the while, physical demand has tripled.
Yep. Look at the numbers produced out of the U.S. Mint or the wholesalers. I listened to the Silver Doctor's interview from the Sunshine Mint. I think their capacity more than tripled since 2008 or 2009 up to today, and yet the price drops. So it's pretty crazy. Obviously in a free market where demand was increasing and there was...
But Jason, think about it this way. Precious metals is a market where, despite unprecedented demand increase, the price has gone down. And our bond market is a market where, despite unprecedented supply increase, price has gone up.
Welcome to dystopia.
There you go. And that's called welcome to engineered outcomes. And this literally is metaphorically, as I described it, it's like murdering something. And this is criminal. This is criminal, because what these engineered outcomes end up resulting in. They end up resulting in geopolitical tensions, and it ends up with countries not being friendly to one another because people know they're getting screwed for their natural resource wealth. And it doesn't make for good international relations. And you see, this whole thing can be bracketed by dishonest commerce, dishonest money, yields contempt, yields countries being upset with one another, and left unchecked can put the world on a war footing. And doesn't that describe the world we're living in right now?
Yeah, and a lot of the new Federal Reserve appointees that are coming on in the next year or so, a lot of them are going to be from Goldman Sachs. And did you happen to see Rob, that Gary Gensler, after he left his commissioner post at the CFTC, where he actually admitted gold and silver markets were manipulated, but said basically people have to assume all markets are manipulated and there's not much he can do about it, he actually went to Hillary. He's the head of campaign finance now at the Hillary Clinton campaign.
Well, good for him. I have a Hillary for prison T-shirt.
Oh, I would love to see her in prison. She's the front runner now for our Scumbag of the Year nominee on our Welcome to Dystopia show.
Well, I'll cast my vote for her too.
Well, I just want to thank you again for your time, Rob. How can our listeners find your work?
You can find me on the web at kirbyanalytics.com.
Okay, great. Well, I look forward to speaking with you again. Hopefully, gold and silver markets they stop free falling, because it's kind of getting like just so negative, the sentiment. It's amazing how much lower. You don't think it could go much lower, and then it goes lower. And eventually, I think there's going to be supply problems in the market. There just has to be, because I don't know how the miners have survived this far.
Yeah, I'm in agreement with you there.